Hello and welcome to Business Today Television. I am Siddharth Zarabi and with me today is Shyam Srinivasan, someone who has served as the Managing Director and CEO of Federal Bank since September 2010. He is now set to be succeeded after a very good and long innings by KVS Manian, the former Joint Managing Director at Kotak Mahindra Bank. As we all know, Srinivasan's tenure, spanning 14 years, will conclude this September, and under his leadership, the bank has achieved significant milestones and seen very solid growth. Welcome to this interview, and I hope there will be opportunities for more, but at least in your current tenure, this is going to be one of your final interviews. So I'm going to start by asking you, as you look back at this very long journey, when you took over as the CEO, did you imagine that you would be spending so much time at Federal Bank?
Thanks, Siddharth. Nice to catch up. No, I do recall in my early days, so to say, I did mention this would be my last job and I'd retire from here. But that was, and I was quite sub 50 when I joined. So I thought 60 would be the retirement. So I've got a couple of years extra. But yeah, I did not come here believing it would be a short one. I came for a long one. And thankfully, it turned out to be longer than what I had originally wished. I'm not complaining. It's been good.
Take our viewers through how you have built this bank. When you took over, if we try and compare it with the size of SBI then or today, there's a very vast difference. How has the bank grown?
As you mentioned, I think the heartening part, of course, we've grown, we've gained share, and you mentioned SBI. On another platform recently, I did mention that SBI is now about 60 lakh crores or a little above, and we are touching 5 lakh, which means we are 1/12 of what SBI is today. When I came on board, our bank was around 63,000 crores, and if I remember right, SBI was about 30 lakh odd crores. The old SBI was much, much, much smaller. So the equivalent of the new SBI. So I think we have gained share, as is visible. Our rate of growth has been higher, and as I can see on your screen, our CAGR is 15% total business. The good news is, I'd like to believe over a long period of time, not many banks have had sustained 15% CAGR. They may have had sort of a period of 30%, then negative, then ta-da-da-da. So ours, I think, has been a pretty, sometimes a boring kind of growth, but I've always maintained in banking, it's nice to be boring and consistent and steady. I want to believe we've tried very hard on that count. So yeah, it's been good, but the softer aspects which get less notice is what I'm most excited by. I genuinely think we are a bank with a heart, which is why we developed this line, the human at the core, digital at the fore kind of mantra. And we've tried very hard to live up to that. So the softer aspects, to my mind, are less advertised, but more sustainable. Financially, mercifully, we have done quite well.
And that's very clear from the numbers under your tenure. Banking has seen a massive transformation from the time that you took over here and now as you hang up after such a long tenure. And technology is one of them. The way banks approach their customer has fundamentally changed forever. And we are also at a time when banks are now seeing some amount of the ground shift under their feet, for example, as they chase deposits with a newer investing culture having taken hold in the country. What are the key changes, according to you, that have been most important in this shift that you have observed?
See, the more talked about thing is the digital transformation that India is seeing, as in the country, and therefore banking is can't be left behind, and banking has been at the forefront of it. And as we as a bank have done our part in some areas even ahead. So if I keep digital aside, which is certainly a material part of the changes that have happened over the years, I think the more fundamental change that has happened, Siddharth, is the way regulations and regulators have shaped the credit standards of the market are day and night, right? Over the long period, say somewhere in the middle of 2000, the decade of 2010-20, came in the AQR and the Bureau as a rich platform for sharing and ensuring that people are not able to arbitrage one versus the other. And then building on that over the years, you've seen that scale up even further, where one by one, systemically, all arbitrage or any kind of asymmetry that was there in the industry have slowly started going away. So what that has done is, for banks and bankers, the need to constantly up tier your game, because when there's asymmetry, there is an arbitrage and people are making money. If you remove the asymmetry and the arbitrage, then only quality will take the franchise ahead. So I think the more important change that has happened over the last decade plus is, besides digital, is the corridor in which you play has become terribly clear. The edges have been slowly knocked off one by one. So asymmetry going away, I think, has fundamentally transformed banks, and which is why probably this relatively benign credit environment in the country is not an accident, it's by design.
Getting to this point has been pretty painful. And I'm not talking about your bank, but the overall banking sector. I remember headlines, pretty much 8 or 10 years ago, which spoke about how Indian banking was broken, allegedly so. The culture and era and allegations of phone banking, the first dirty dozen companies that were marched off for insolvency. It was a very, very different time compared to now, when I haven't seen the banking sector in India as robust ever in my own career. How has that come about?
Yeah, I think that's a good point that you make, and that's exactly what I said. I think the range of sort of interventions from a regulation and the platform that is available for banks to share and benefit and share and contain have moved almost, you could mark the calendar, and every couple of years some new intervention has happened. And in the more recent past, many more regulatory, almost prescriptions that have made sure your wriggle room is less. So the wheat from the chaff kind of distilling has already happened quite nicely. As a result of it, you're seeing all the developments, let alone the overall public infrastructure and digital improving, let alone the insolvency process coming in. But the need to report into a common database, which can be accessed by all banks at any point in time, means you have no choice but to have the most current information on your borrower. And with that in hand, if you make underwriting decisions, informed underwriting decisions, chances of going wrong is lower. Additionally, it's a period where the environment and the economy have also started picking up, and India is having its better days. So the confluence of great platform, digital, and overall economic sort of relative uptick, and the appetite for banks to lend more because balance sheets are cleaner, corporates are less leveraged, have all sort of come together nicely. And like many have commented, this is probably that Goldilocks moment where everything looks quite good. Can something go wrong? Yeah, there may be some new event that can come and spoil the party. But I think the amplitude of bad will certainly not be anything like it ever was, because of the reasons we pointed out. The so-called wrong practices or asymmetry-led sort of arbitrages have all slowly been chiseled out.
Do you think there's also been a bit of overprescription when it comes to banking regulation and policies?
See, there's always a view, right? I mean, when you are the one who's being regulated, you want a lot of freedom. So if I if I say that, yeah, I would like sometimes to be a little ease, but I think the Ogilvy's line, right, give me the freedom of a tight brief. Is probably what the regulators are following. They're giving you a very tight brief. And I remember one of the intervention engagements with the regulator, they did say that as long as you're playing within your playing ground, we are not going to intervene. You do your stuff. So I guess that's the script. The tight brief is play within your script and play. So yes, you'd like it easier, but that's where the challenges crop in. So I would like to believe that we should accept it and play within that field.
I'm almost reminded of that old saying that you can have any color of car as long as it is black. But one of the other issues with regard to banking has been the fact that the peculiar nature of our growth has been driven by banks. Unlike many other countries where the bond markets are far more well developed, and ever since I have been a reporter, I've seen multiple reports, multiple attempts, committees to develop that. How would you describe the future for banking when it comes to supporting broader growth objectives, particularly of high risk, long gestation sectors like infrastructure?
It is one of those enduring challenges because the bank's money is typically depositors' money, which is shorter tenor, right? So we can't lend long by borrowing short. So that gap or that challenge will be something that has to narrow over passages of time. So can infra funding, which is a sort of a crucial need of the country, be solely met by banks with its balance sheet? It is less possible, right? So that's where the secondary bond market development, and then you come in, you play your part after the project is completed, and then you come in for other requirements of the client. But the larger part, the India story certainly is infra and inclusion. Both ends of the spectrum has to happen, longer tenor and inclusive. So banks have to figure out a way. Bank money is shorter money. Bank can play part only when the projects are up and running. So you do need a kind of a market which gets it off and then banks step in. So I don't think singly banks can do that. But healthy, stronger, bigger, more constructive banks can play a bigger part. This may bring the case of how the structure of the banking system will be. Will there be like 4 or 5 very, very solid, strong, big banks who can play that part, and then a bunch of other players do the residual activities? So the shape of things will play out in the period ahead, but banks by themselves cannot take care of this large requirement for infra. So government and various other bond instruments have to kick in.
Uh,
Have to
is there
kick in,
scope?
not kick in will happen.
Okay. Is there scope at the industry level for consolidation, and do you think the regulator needs to encourage that or have a hands-off policy, let market forces work on that?
No, I think the second will happen because the 12 public sector at the end of the day, one common owner, right? Then the large number of private sector banks have different ownership structures, different markets where they're dominant, prominent in. And shareholders, therefore, have different say. I think a forced consolidation usually happens only when there's a crisis. To my mind, that doesn't exist in the system today. Then it has to be a commercially important decision each board of each bank will have to take. But I think here comes the challenge, right? Any bank, if it's not the government, PSU, then in the private sector, every bank has its own ownership structure, and everybody would like themselves to become bigger. And if that is the case, and you can't do hostile stuff, so two banks boards have to board shareholders have to concur on why they should come together. And then there are technology platform issues. As we get bigger, platform and technology is going to be the single biggest integration challenge, let alone the culture and compliance and people related. So is it going to be easy? No. Will it happen? It has to happen at the will of the boards and the shareholders and not by some diktat. And that will, market forces will determine it, Siddharth. I don't think it's going to be a sort of a mandate or a prescription on the private sector. The public sector, I can't quite comment because at the end of the day, it's this one, sort of large common owner. They may dilute up to a point for commercial outcome, but I don't know if they will sort of merge it.
Does it make sense for the government of India to remain so heavily invested in banks? Because when I put this question to policymakers, they say, oh, there are multiple objectives, social objectives, policy objectives to ensure there is credit made available to deserving sectors. But does the government need to remain so heavily invested in the banking space?
I think they have made it clear that over periods of time they will dilute. Now, whether they become dilute to the election, they become less than 50, less than 26, or remain a strategic shareholder, I would think I don't believe it's just one consideration. It may be many things, and we have to be very sensitive. These are organizations which have rich and long histories. They have large workforces. Their platforms are different. Their client constituencies are different. I don't think it would be sort of one stroke and it'll all happen. Like I said, the two or three, whichever are going to connect up, have to apply heck a lot of board and mind time because ultimately you're dealing with crores of customers and lakhs of employees. If they are either displeased or uncomfortable, then it's going to be hard to pull it off. So I come from the camp that says that it has to be desired and both commercially and culturally viable for it to go through. So I would think it's case to case. I mean, I don't have much of a more studied view, but this is what I would say is my personal view on how this should happen.
You've laid a very, very strong foundation for your successor for the future. And while he'll kind of come to grips with the job and, lead it in his own way, what will the Federal Bank of the future, let's say in 5 years, look like from now?
I think Manian will answer that better. But I think, see, one line we've held on dearly, is there on the screen, is to be the most admired bank. And the good news is when you say the most admired, we are not saying biggest, most profitable, largest share, but we genuinely want to be admired by all stakeholders, not just just shareholder. It has to be regulator, employee, clients, the whole works. And we have some hard measures on ensuring that those are met. Arithmetically, numerically, I'm reasonably sure in a 5-year period, we will be 10 lakh crore or more if we keep this kind of growth going, right? And which is no reason why we should not. And I think the platform is good. You mentioned we have the average age of the bank is 34. And each year, the average age is coming down by 1 year. We are a very, very digitally devoted team. So I think age, a good platform, digital capabilities, a conducive market, all point to the fact that we should be able to double or more in the next 5 years on all measures. And if that were to happen, we would be certainly, a formidable top 5 in the country in the private sector space.
Okay.
Organically, I think we have a good place to be in the premium league of banks, which is not a bad thing. Over a 20-year period, if a bank has moved from being a relatively regional local bank to a very prominent top 5 in the country without too many scars, I think it's a good place to be.
How much of a concern to this goal and objective that you have outlined, a premium bank, is the widening credit to deposit ratio? That's not for your bank alone, it's an industry issue at this point of time, but seems to be a growing concern.
I think, Siddharth, that is a point in time issue. I mean, I am not of the view that this will be the model forever, right? I mean, take our bank. 5.5 years back, we were at 68% CD ratio. Today, we are at about 84%, right? And that's been our internal norm. We don't think we will cross that. We may even slide down slightly. But again, at an industry level, There may be a few banks in the 100 who are all sort of being guided to be lower. Growth, as long as you're able to grow your deposits and credit in tandem and keep your CD ratio in the early 80s, I believe it's a good place to be. So am I worried? Is that going to be an industry problem? No, for big and well-run banks, it will not. And the industry is largely guided by the top 10 big banks, and the rest sort of hold the tail. So I do think it's possible. CD ratio may be a point in time, but we must, even the reports that came out from the deputy governor only 2 days ago, how the household savings have started creeping back up. And this seasonality of last 2 years post-COVID, marked shift in how people engage with money is beginning to change. And I think, how many more cars will people buy and how many more houses they'll buy. So some will go into the banking system. And we know money creates money. So if you lend more, you'll create more deposits. If you create more deposits, you'll have the ability to lend more. So I think this will autocorrect by, if not 24 end, early 25. You will see deposits too picking up. Having said that, cost of deposits may inch up because if the war for deposits hots up, then the efficiencies of banks have to go up. I am making the case that this NIMS, as we all get excited by, is only one measure, and it has probably outlived its relevance. It's the incremental growth in income versus incremental cost structure that will define very good banks.
Shyam, since we are speaking about this issue of cost of deposits, and you described the situation as one that is, a point of time, transitory one, like you point out, is the situation such that the demands that were made at the banking association level recently to bring some parity between fixed deposits and the kind of tax architecture that prevails for mutual funds, do you think the situation deserves that the policymakers consider that very seriously?
I mean, that appeal has been going for long periods of time to treat fixed deposits differently. Now it's getting more pronounced because the rate of growth of other instruments have increased. So therefore, the competition, so to say, for the money that is in the client's wallet to go into the banking system or the mutual fund. I think the one point to that, all of us know it, but I'll just say it. Even if it went into the mutual fund industry, it comes back to the banking system. Only thing, it moves from retail to wholesale. See, the money is still in the system. It's not going away. It moves unless it's going out of the country for some purpose. That's something that none of us can singly explain. So I think in the long run, if the economy is moving well, the markets are moving well, which I think it is, and jobs are being created and not lost, then the lubrication of the system continues. Deposit creation will happen. But maybe that's why I said the cost of deposits may change its texture from being what we traditionally know as savings and current account to maybe savings, current account, fixed and other forms of money which are bulk in nature. But notwithstanding all that, I think the availability of money will be there. The cost of money may inch up, and therefore the banks have to recalibrate either their cost of lending and or their efficiency and their cost of credit. So that will be the new formation as I see it.
Since you speak about the cost of money, your thoughts on the medium to long term interest rate environment that is going to prevail in India. Why I ask you this question is that if you compare India's growth aspirations and aspirations at an individual level of borrowers, and of course corporate borrowers as well, but corporate borrowers have access to more sophisticated forms of finance. The cost of money is something that is already an issue and will continue to become an issue. What can the average borrower in India expect? Because what the average saver gets is clearly known, but what kind of interest rate environment should the average borrower be prepared for over the medium to long term?
I would only use what our regulators say every time after the MPC, that they'll be guided by the data, and then make calls, but it is quite clear that, from every statement that we hear, they are looking out for conviction that inflation has sort of moderated and it's closer to their objective number of 4, plus or minus 2. If that be the case, it's not sustainably closer to 4. So the rate cut may take a little longer, even if the US, which is expected to cut
Is
rates.
4 sacrosanct? Is 4 relevant? Shyam, I am interrupting you because is it cast in stone, and why should it be?
A good question. I wish I had a more say in that, but I think if that's what they have signed up to, unless they sign up differently and they're influenced differently to believe 4 is not necessarily sacrosanct, it can be 4.5, it can be 5. But we must be careful that in all these calls, if you react to a near-term demand, it can have ramifications over a 3-5 year. Today, India is sitting in a definitely a better place than much earlier and many others, only because some of these calls which look tight 3, 4, 5 years back are playing out well. So to suddenly react and say, 4 may not be appropriate, let's take it up, may cause consequences. So I'm making the case that if the, like in credit too, as that you may know, it's not about the high or the low number. It's the predictability, whether it's going to be in that zone or is it an escalating problem, or is that an uncontrolled problem. So if the government and the country get the feeling that we are going to be at 4.5 for long periods of time, and that's predictable, maybe they'll recalibrate. But the direction of that line has to be more clear. I think that's yet to form.
Absolutely, and this, like you say, is a much bigger debate. And before I move towards the last part of our conversation, it's a debate that perhaps also needs veteran bankers like you being heard when it comes to formulating the tent poles of monetary policy in terms of the legislative architecture, or taking into account the vagaries of food inflation and how that ends up making many other forms of borrowing more costly. But we'll leave that for some other time. I want to ask you, as you are stepping down from Federal Bank, if you were asked what kind of legacy you have left behind, how would you describe it?
I have this famous line for myself: I'm happily dissatisfied. Right? my personal philosophy, I've tried to enshrine it in the bank. I think the bank is also quite signed up and restless about. We are happy, never unhappy, but never satisfied. I've always held the view if the management or the seniors are satisfied, I think end is near. So I've sort of tried to keep that as my philosophy. In many ways, I think it's the bank's philosophy. So we're happy, we're dissatisfied, we push for more, we try hard, and we try to be most admired. I think those lines are deeply ingrained, and I do believe Manian and the board believe in that. So if I were a year out as a shareholder asked the question, I'd like to test to see that these are holding out quite well. So then I would know that the 14 years didn't go sort of unattended.
What's next for you?
Nothing at all. I have nothing. I mean, I'll be associated with one of our subsidiaries in the bank, in the board there, but outside of that, nobody wants me, Siddharth.
No, I ask you this because having known some other former veteran bankers, I know you are used to a certain pace of work, a certain kind of work environment, and I think just as army men and soldiers find life difficult after environment to settle to a slower pace, I guess you will also be in the same boat, Shyam.
We'll see. I don't know. We'll see what holds, but I'm happy to sign off well and look forward to a new chapter, whatever that is. I'm ready for it. Let's see how it goes.
And we wish you all the very best for your future, for your next innings, and hope to see you again commenting about many other matters related to the economy and the banking landscape. Shyam Srinivasan, I wish you all the very best, good health and lots of cheer in the days ahead, and Thank you very warmly from the entire Business Today television team. Have a good one.
Thank you so much, Siddharth. Most appreciated. Thank you. All the best to everybody.
Bye-bye. With that, it's a wrap on this conversation with the outgoing boss of Federal Bank. We'll be back with more. Until then, goodbye.
The terror of wolves in Bahraich continues. The death toll due to wolf attacks in the region has reached 10, including 9 children.